Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. We're about to listen to what Jerome Powell and the Federal Reserve have to say today. No rate cuts will be expected. You guys know what that means. Inflation, hidden inflation. Let's see what he's got to say.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 3/4 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timros, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But, I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. So you had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira.
Thank you, Chair Powell. Mara Mokway from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook and all that. And, we're in a position where, we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Ladies and gentlemen, check these stats.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, ex the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff
Ladies and
increases
gentlemen,
that are begun.
I don't know how much longer
over the course
it
of
could
this
take
year.
this.
If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President
Devaluing
Trump
your
does pick
currency
a new
at
Fed
the
chairman
same
before
time
May,
causes hidden
what does that
inflation.
look like? How would you work with that
2%
person,
is a
and what does that
fantasy.
transition
It's
period
no
look like?
longer
I don't have
2%,
anything
nowhere
for you on
near
that.
2%.
That's
Tariffs
will
actually
depend
increase the values on
Congress's actions,
companies,
things I
which
can't
they
speculate on.
transfer to the consumer.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked.
He's referring to
at
treasuries,
all of the both
bonds.
survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Fantasy. That is fantasy.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
You know, we haven't made, you're right, we saw the labor market weakening.
Finally,
And we
somebody
acted.
calling out the BS.
And I think that's the appropriate thing to do. We have, you know, we will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, you know, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that
That's
suggests that
funny.
there's much to that.
They're spending billions to prop up banks. Overnight
This one's in the New
repos.
York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you know, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, you know, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico.
Wow.
I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
You know, over time, you've seen that U.S. rates have remained pretty, they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, you know, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But you know, right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that, you know, in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the
That's
effect of
crazy
your
what
rate
he's
cuts
saying.
that longer-term rates have overall not really budged that much?
I wouldn't say that. You know, the thing is, I mean, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but, you know, it's much more, you know, assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between, you know, 10-year rates and the overnight rate.
That is correct. It's a 10-year rate. and
Thanks so much, Elizabeth Schulze.
mortgages,
ABC News.
ladies and gentlemen.
Republican
That's
Senator
what
Tom
matters.
Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve
Stopping us
well.
from being China.
It can maintain
He
that
says we don't want to be
independence at this
China,
point.
is what he's saying.
Yes.
CCP
I'm strongly
and other
committed to that, and so are my colleagues.
dictatorial countries.
Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. Just one reading, but it's an indication of softening.
It's already soft. People are needing more than one job, and all the jobs, you can search it yourself. People are not getting callbacks, but they show availability. So I don't know what stats he's going by.
Places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in
That's the problem right there.
That you could say that's full employment.
That's
At the
not
same
full
time,
employment.
Do we really feel like that's a
That's what's
maximum
going on
employment
right
economy?
now, ladies and gentlemen. He's
It's a
sugarcoating.
challenging- It's a very challenging and quite unusual situation.
Thanks. And one more. On growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing, how much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal...
Tax
I
cuts
think
allow
the outlook, you're
the
right,
corporations, the
financial
banks,
conditions,
to get
and it's,
lower
it's
rates for
fiscal
their
policy
borrowing,
for 26.
not for the United States
But
citizens,
you've got strong consumption that's been happening before.
and gives a cut to the
financial conditions have
corporations
been
and to
supported,
the
but
wealthy.
Before the fiscal
And us, the
effects really are
taxpayers,
shown.
pay
So
for it.
essentially, the economy has once again
in the form of
surprised us with its
deficit.
strength, not for the first time. And consumer
Interest
spending,
is owed on the
although
bonds at
it's,
4+%
across,
annually
income cacategories, but consumer spending overall
by the
numbers are good.
taxpayers
And
every time they print money.
benefiting from the from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality.
That's because more people are living paycheck to paycheck.
But they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
Yes.
So everyone, of course, is watching AI and the deployment, and trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Becky.
Thank you, Chair Powell. Beyi from
We track the effect of those tariffs. Our estimate is it'll be sometime in the middle of the year, but I will. Think,
I think
a lot of it is around energy, oil, and so far we haven't. And the trade. Trade policy, the U.S. economy.
We're going to end that because I can't believe Jerome Powell is still tap dancing around the situation. So, once again, we're having a major problem with our economy. Let me know what you guys are thinking right now. All this mumbo jumbo that they're out here giving is crazy. All right. It's what he needs to say for our government, for people to, on the surface, he gets to say things that are nonsensical. He gets to say things like, hey, we're at full employment. Okay. I don't know where he lives, but it's definitely not full employment. These are the things that is a problem because when you live in your big glass fancy houses, you get information, then you decide to turn the information inside out to come up with a press conference like this, trying to help. Now, first of all, you have to understand the Federal Reserve is based on helping the wealthy. That's why you have to invest in stocks, a little bit of gold, a little bit of crypto, a little bit of silver. This is the whole point. The Federal Reserve solely exists to increase the stock market and increase asset values. They don't care about inflation. They use the numbers, but it's clear they don't care about the numbers. If they cared about 2% inflation, and if inflation is not 2% after a whole year goes by, then the normal thing they used to do was increase rates in order to get the inflation down. But they're not doing it. So instead, what they're doing is overnight repos to create liquidity for the banking system and financial systems. But they're printing money. Every time somebody buys a treasury, every time treasury bonds are bought, that it allows them to create money out of thin air. And by the way, all they have to do is print 100 million because of the banking fractional system. They do not have to, they can give the banks $50 million. The banks, due to fractional reserve system that we have in America and around the world, they can loan all of it out. They don't have to keep any amount of that money in the bank. They can risk 100% of it, which is what they are doing. So when people go in to ask for their money in large sums and they say, hold on, wait a minute, that's a reason. And they printed more money, which devalues your currency. And all you have to do is go to DXY. So if you see DXY is at 95, it's not at 100, then do you know what that means? That means you have 5% less buying power. All right? That's a hidden inflation you can't see. Meanwhile, he's on stage talking about it 2% when it's not 2% inflation. Even if inflation was to their fantastical, ridiculous, nonsensical 2.8 or 2.7, you have to add 5%. So in reality, it's 7.7. All right. And it's been worse. Let me go pull up the chart right now from Trade and View. Let's just go see where it actually is. This is also the reason why he sat up there and fudged. And he says he didn't see anything about countries taking out treasuries or bonds or anything. That's not true. So again, that's ridiculous. It's happening. This is why gold and silver. So anyhow, the US dollar index right now is 96.47. So you're down 3.5%. All right. So that is hidden inflation. So when you go to the store and you go, wow, man, things cost more, it's because it's not 2%, as you very well know. It's more like double digits, and there's reasons for that. When they print money every day, that's another devaluing of your currency that we have to pay 4.2% or 4.1%. So when they do overnight repos, all right, let's go this overnight repos. Federal Reserve, let's see what they did. Well, let's see, January 27th. Let me see if it comes up. Let's see what they did today. So what they have to do is banks don't have money, right? So they have to send it back and forth between each other. Let's see, we don't have yesterday's. Let's see, 27. You know it's going to be billions, at least. All right. Again, where are they getting that money from? Taxpayers. All right. Let's see. Do we have any info on this? Let's see what we did. Okay, here we go. Is that 100? What is that? Is that 110 billion? I don't know. But the point is, accepted was 1.103, all of it, and they're offering the 3.5% rate. That is the Federal Reserve rate. So if he would have came out and said 50 basis points, that would have brought it down to 3%. That allows the banks to borrow from the Fed at a lower rate, which now means they can give corporations lower rates. But I will tell you this, if you had 3.5% interest only, I think you would be rocking with that, right? Where you don't have to pay back your interest. Think about it. I mean, pay back the principal. Think about it, all right? For a little while. But this is overnight. So every night, they have to make sure the banks are liquid. The financial system is liquid. If they didn't do these overnight repos, guess what would happen? A credit freeze. You can't get loans. Corporations will have to pay a higher rate because then the Federal Reserve would increase the rate. So all of this is what's been happening in the background, and he won't tell people. And that hurts us, American citizens. You are in trouble. I've said this several times before. You live in a third world country, but you don't know it yet because we have credit cards. If they turned off all the credit cards, you would find out real fast. And about this job thing, by the way, you know what? Let me put this up. I just can't. This is just crazy right now. Watch this right here. Look at this. There you go, ladies and gentlemen. You can see right here, 1.103. All right. Let's go look what this means exactly. All right. So, all right. Yeah. So it's 1,103,000,000. Last night, the 27th. Guess what? Every night they're doing this. Every night. Okay. So let's go. Here we go. How much in overnight repos last week, January 2026? Total. Just put it in there. But check this out. Let's see if they give us a number. Okay. Monday, Treasury, January 20, sitting at approximately 1.25, 1.49. Here you go. There you go, ladies and gentlemen. 1.2, the 27th, 1.48, the 26th, 0.927. Look here, January 27th, 2 billion. January 21st, 3 billion. Every night they have to do this. Overnight agreements. This is crazy. And again, it's at 3.5%. This is why the administration's trying to get the rate down, because then they can borrow at zero. Most people start going, oh, that gets to take care of our debt. Ladies and gentlemen, it doesn't take care of our debt just because you reduce the rate. You still owe the 40 trillion plus dollars. You still owe the $1 trillion. That's already paid out because they bought them in bonds. That's why people buy treasuries and bonds, because they get 4%, 4.2, 4.5, whatever the case may be today. So that is an IOU regardless. There's nothing you can do. It's not going away. You're kicking the can for the grandkids, great-great-grandkids, and so on. Let me know what you guys think. I just get upset when I economy is. So therefore, you guys have to understand there's a lot of things going on around here that people do not care about. I'm going to wrap this up because this is disheartening to listen to this guy get up here and he says things that a lot of people don't delve into to find out. And I'm going to show you guys something else just so you understand. This thing he was talking about, transportation companies. Check this out. due to tariffs, you have less shipments coming into the United States, which now means the fallout from all of that. So the container business, the people that transport the goods and services that come into the country via shipping and air flights, that's less. So therefore, the transportation companies are going out of business, which means those are livable wage jobs because the drivers and everybody that's associated with the packers, the shippers, and everybody, there's less shipments, there's less jobs, there's less people making livable wage jobs. That is a problem. And that problem translates in, just like farmers, transportation companies going out of business. Okay? Let's go look it up. You can Google, ladies and gentlemen, until they haven't figured out how to block it. Here you go, ladies and gentlemen. You want to know how many in 2025 the U.S. trucking? You know what? Let me just do it this way. I don't want you guys to sit here and believe just what my rhetoric may be. Let me give you guys the real deal so you can see yourself. Then you start getting upset like me. Maybe. Because then you'll start realizing all this BS about tariff. All right. So here you go. Key findings. In 2025, the U.S. trucking industry experienced a severe ongoing contraction known as the Great Freight Recession. You guys got that in your vernacular yet? With estimates indicating that 5,000 to over 36,000 trucking companies have either shut down or filed for bankruptcy. Shut down or filed for bankruptcy, which now means the companies that support those trucking companies will not be getting paid because they filed bankruptcy. You see how this goes? Now the mom and pops in your city now have a problem also. The transportation hub, the warehouse, that's not going to be utilized any longer. Contraction all the way around. So when Jerome Powell gets up there and starts this BS, I'm sorry, ladies and gentlemen, I'm not rocking with them. You can see this right here. This is not like he just said no problems. This is jobs lost. Look at this. As of early 2025, reports indicated more than 1,500 trucking companies were shutting down per week. Now, what does this look like to you? We're talking about 5,000 to 8,000 carriers formally exited, with 36,000 companies closed in 2025. Remember when trucking was great? People were all getting into it? Well, guess what? Less shipments coming in due to a tariff. You want to act crazy? Well, you F around and find out. But see, Americans, you don't realize that what's happening under the hood. You're thinking everything's fine. You're listening to Trump. You're listening to Powell. You're listening to these people on Fox, CNN, all these news channels, CNBC, all these guys. They're not sitting there telling you, look, this is what happens. And now we're effed. Just in transportation. And by the way, if transportation's going out of business, then that means there's less transportation companies, which now means the cost of goods, right? That's what it's going to mean, ladies and gentlemen. The cost of goods just from transportation. So it's not the goods itself. The transportation cost is going up because there's less competition. It's capitalism. This is very simple. They're making the mumbo jumbo stuff. So most people go glaze over their eyes and go, wait a minute, he said everything was fine. He says there's jobs. Okay. Everything he says is crazy. Thank you so much, GG. I appreciate that. Great channel, great information. Thank you so much, man. I appreciate that. And welcome to the afternoon edition of the SSN Nation live stream. So once you understand that all this stuff is BS that they're saying out here, your dollar is less than it's worth every month. So that's hidden inflation. Your taxes are going up because the hidden inflation affects everything. So now think about this. If you tell me, once you understand how this goes, when he says, oh, there's no inflation through the system. Okay, well, let's get to it, ladies and gentlemen. What does he mean? What does he mean by no inflation in the system? Uh-oh, changing back and forth. What does he mean? If you know the dollar's devalued by 3.5%, for instance, that means everybody that transacts now has to spend $3.50 for every $100 more. It doesn't go away. So now you sit there and go, okay, well, then what's the other inflation? They go, oh, well, our consumer goods and all this stuff is only 2.7 or 2.8. I don't even know what it is because it's BS anyhow. So now you're going, oh, wait, hold on. We know it's 3.5 plus 2.7. So we know at least it's 6.2. But then you go, oh, well, our farmers are going out of business. So now you say, oh, we're going to take our farmers out, have less labor that we're deporting or jailing. So now they can't function. And then they turn around and tell you, hey, we're going to print $12 billion to send to the farmers to bail them out. Meanwhile, why don't we find out how many farmers have gone out of business? Okay. Now, where are we going to get our food from? Where are you going to get our food from? It's going to cost more because we don't have people picking the fruit. Here we go, ladies and gentlemen. In 2025, an estimated 2,800 dairy farms are expected to close, with farm bankruptcies exceeding 2024 levels due to tight margins and high debt. Only about 52% of U.S. farm borrowers are projected to be profitable in 2025. That's correct. That's why, if you did not give them the 12 billion, the 15 billion, whatever the number is really going to be in bailouts, some of the farmers are going to get the bailouts. Then you'll understand. All right. But here we go. Driven by a surge in small farm bankruptcies, particularly in the Midwest and Southeast. More jobs gone. The feed store, the people that package it, the food, the grains, the hays, the bundles, all those jobs gone. For 50% of farmers. Some more livable wage jobs in small communities. Are you getting the picture yet? So this Jerome Powell tap dancing because people don't want to call him out. If I'm on, they're not going to let me on that stage. They're not going to let me anywhere near these guys because I'd be pulling up all this stuff going, what do you mean we have a nice full labor supply? What is he talking about? The only reason there's a labor supply is because just what he said to that one lady, one truth. Well, he said several truths, but one of them he got in when he said, well, I'll give you guys an example. I can't remember what he exactly said, but his example was basically, let's just say we have 100 people to make it simple. All right. And so basically what's happening, according to him, and what's really happening is we have 200 people looking for a job. The 100 people lost their jobs. So now this, and let's say they were transportation jobs, out of business. 50 people are gone. Guess what? 200 people are still looking for jobs. The way they calculate stuff, oh, it's full employment. I'm like, you're damn right it's full employment because a whole bunch of people lost their jobs and now there's less jobs available. So when the people get a job, now you get to say, oh, unemployment's only a small amount. Yeah, because we lost jobs. Let's go with manufacturing jobs, ladies and gentlemen. Okay. Manufacturing jobs. How about this? Let's go look. Some more livable wage jobs. Here you go, ladies and gentlemen. The U.S. manufacturing sector experienced significant declines, with estimates showing a loss of approximately 72,000 jobs throughout the year. And of course, largely driven by tariff policies, just what I told you guys 2 years ago, what I told you guys 5 years ago. Tariffs are not the way to go. So this is based on what they are saying. So if they're saying 72,000 jobs, I'd be willing to bet you it's double. All right. So they don't like telling the truth. So therefore, some more livable wage jobs are gone. And by the way, manufacturing facilities, once again, transportation, electricity, heating, AC, roof repair, mechanics, vending machines, all of that. Mom and pop businesses that supported these manufacturing facilities, poof, gone because the manufacturing facilities, poof, gone. Do you guys understand? This is a crescendo going down, and this is like the Great Recession, except it's the Great Depression. That's what's happening right in your face. All right, let me know if anybody doesn't understand this, because this is crazy when you start looking at all the metrics and have these guys who supposedly run the country, but they're not running the country based on looking out for you. They're running the country based on those looking out for us who invest. That's what it is. They're not caring about if you're going to have a job next week. They don't care if you have health care. They don't care. They downgraded women, or not women, but nurses, and it's no longer a professional job. So now those people, just like teachers, have to pay for their new information. They can no longer get a loan to go to their schooling. So now you're going to have inept people that are going to be nurses, CNAs. And I shouldn't say inept. What I mean is, in order for them to get information on the new procedures, new, not just procedures, but equipment, they now have to come out of pocket, just like a teacher. And now, what's that going to do? I would not want to be sick, ladies and gentlemen, if I live in America, because you're going to have a bill to pay and you may not have top-notch help. And that goes all the way down. Doctors are one thing, but when you start getting into the staffing and you start saying that you're going to restrict if they can get money to further their education in the health field, and now you're going to act like you're going to put a cap, you know what's going to happen. People can't afford to say, oh, yeah, let me go spend 60 G's or 50 G's or 30 G's. 80% of the population lives paycheck to paycheck. Let's get real. All right. Let's go one last thing while I'm up here, because that was the farmers, wasn't it? Or manufacturing jobs, because I want everybody to see. Total jobs lost 72. Actually, it's 160 something, just so you guys understand. All right. And that's 2025. But here's another 8,000 jobs, lost another 8,000 jobs in December. And now we got 72,000 jobs for 2025. January, December, it lost 68,000. So again, December alone, that is crazy. From April to December, manufacturing 72,000. From January to December, it was 68,000. Either way, they had to redo the numbers. All right. So that's a lot of jobs lost, ladies and gentlemen. Livable wage jobs, by the way. So where are these people going to go get jobs? Okay, let's go. I forgot what I was going to go to next. And this was going to be the last thing. Make sure you smash that like button. Make sure you share the videos. Oh, by the way, if you guys still need help out there, findhelp.org. Matthew Lesko, the guy that used to wear the question mark late night, came on almost a year and a half to 2 years ago. He said, just tell everybody to go to findhelp.org. Put in your zip code. There's a massive amount of help. Nonprofit companies, sometimes it's free, sometimes it costs. That's why you got to make the phone calls. You need help with rent. You need help with fixing your car. You need help with schooling. You need help with medical, caregiving, job training. I mean, the list goes on, depending on if you're near a city, because the cities have more services, bus passes, subway passes, whatever. There's a myriad of things that can help you and your family and loved ones out. And put in your zip code. There you go. That's something for American citizens, right? If you have mental health, that's on there. 211.org is also part of findhelp.org. So they have the mental health facilities up there as well. So they have a bunch of things that can help you. And I already know what I was going to go to was another thing, was the credit card. Okay. Debt. in USA. Total all-time record high, ladies and gentlemen. So again, you guys got to think about this. You need to get your credit score at 775. You need to reduce your debt. Here we go. Total U.S. credit card debt reached a record 1.23 trillion in the third quarter of 2025. It's only going to get worse. Okay, 6% rise in balances year over year. It's only going to get worse. Therefore, if you have great credit, I predict in about 6 months, you guys are going to see 0% interest for 36 months. That's right, 0% interest for 36. We see the 0 for 24, but they're going to want the best. Just like insurance companies want the best people that aren't going to file a claim, that's what's going to happen with credit. Because after the credit meltdown, when these people aren't going to be paying it back, the liquidity problem is going to get real. And so therefore, this is where we're heading. So you have to understand, this is what it is, ladies and gentlemen. Don't sit around here playing, all right? This is going to be very, very bad. Okay, here we go. Robert Bunnell, he has a comment. 40 years of sending our factories overseas. NAFTA, 40 years of shipping and cheap illegal labor, undercutting Americans, benefiting global operations. I've been here the whole time and watched it. Robert Bunnell. Okay. All right. Let's just start with the first things first. All right. Everything you're saying is appropriate, but I don't the situation, the blame game scenario, I look at differently. If I'm a car company, a manufacturer, or I'm a manufacturer, and we say, okay, we're going to come up with NAFTA, ill-advised, but I will say we're going to come up with NAFTA, and you say, hey, Canada and Mexico, can we ship? We're going to have our products and services made in your country, and that'll allow us to ship it to America, and we'll have 0% tariffs. So everybody benefits. Well, not everybody. Like you said, the worker is screwed because they're going to export that job. The American citizens benefit because the actual product is going to be cheaper. So now you have to ask yourself, which way do you want to go? Because you already know nobody's voting to increase wages. I hold on, I shouldn't say nobody. GOP party will not vote to increase the minimum wage. They don't want livable wages. So therefore, that was ill advised. At the time, it made sense. And you know why? Because Americans needed more money to live. So in order to produce these same items, they're going to cost almost double. And can you imagine if everything costs double right now? That was not sustainable. But you are correct. By creating jobs, let's just say in NAFTA, let's just say China, because that's where, and Vietnam, and Singapore, and where else did they go? India. Because they are all countries where people were getting pennies on the dollar per hour. So why have sweatshops in America? Well, we still do. But the point is, that is what happened worldwide, globally. And by doing the global scenario, that is what started happening. Because, like you said, factories overseas are overseas in a whole bunch of jurisdictions. I just named 5, and there's more. Because you start going to an island in the Caribbean, you start going down to El Salvador, you start going down to Venezuela, you start going to Guatemala, and all these places. United States has been, and the EU have been using cheap labor. Now it catches up with you because now you don't have manufacturing facilities in the United States that can produce this stuff, let alone get some of the resources. And so basically, you did a self-fulfilling prophecy. Now we have a new situation in the last 7 years where Trump rolls in and he does the unthinkable, tariffs. Well, that's not going to work. The rest of the world is using cheap labor. So the rest of the world gets the products for less than what we get them for when you add tariffs. So if you say 25%, okay, fine, but the rest of the world doesn't have to pay 25% for that same product. So their citizens are safe. In America, the price goes up at least 25%. And then because you already know the transportation companies are going out of business, you know, the farmers are going out of business, all of a sudden, all that cost built in to get it to your door or get it to the store now costs more. Now the store space costs more because your energy bill, their energy bill, and insurance bills went up. Unsustainable. So now they have to charge more because their overhead is more before they even get the products. So all this comes together, which the Federal Reserve doesn't even like talking about. And you're right about benefiting global corporations. And that's why here we talked about having an offshore bank account. You should have an offshore business or real estate outside of US jurisdiction. Highly recommended. All right. Those are all the things that you have to do out here. So I can't listen to Jerome Powell. I want to bring my hand back and be like, wake up. But I know why he's doing it, because we have this regime that's, you know, could hurt people. So he's soft tap dancing. You know, he doesn't want to say what I'm saying. See, I'll get banned when I come back through the airport, right? So he can't say what I'm saying. He has the tap dance. And he can't say what Robert Bonnell's saying either. So this whole slide downhill benefits the rich because they get cheap labor from American citizens. You guys know what I'm talking about. Somebody gets fired, then they tell you, oh, we need your help over here because that person got fired. We need you to take over and take part of what they were doing. And you're looking like, well, I used to be looking like, that's not my job, but I'll help you out for a day or so, but you need to hire somebody. All right. And oftentimes they will not. And then they divvy up that extra work to somebody else and keeps your pay the same, doesn't give you any additional benefits, starts talking about mandatory overtime. That's not sustainable. And then people have kids and now they find out their bill for their child's daycare is $1,000 or $800 or $1,200 a month because they got two kids. I mean, this is where we're going. This is not sustainable. So I'm very happy you mentioned all this, because all of this has a crescendo. All of this is moving toward a bad space where the rich have all the wealth and the leftovers is down here with us, and we're going to be crumbling, fighting it out in the streets for the leftover crumbs, like it's 1933 all over again. They took it all. Exactly. Fiat dollar collapse. Oh, Robert Brunel. You know what? I don't know. I talked about this for years. Let's look at this, ladies and gentlemen. I'll just do this. Currency go to zero in the history. Let's see what of the world. Okay, all fiat goes to zero, ladies and gentlemen. Just so you know. All right. Nobody can stop it. Okay. Okay, look at here. Look at here. Look at here. Do you see it? You see it on screen? Right. Right. You see this? That says 100% failure rate. Just saying. Exactly right. That's what I've been telling people for years. You can Google it too, but since we're talking about the feds, so now that you understand you're going to zero, that would make your life understandable. When the Federal Reserve is helping the stock market go boom, you have to be participant. When gold and silver is going through the roof, because everybody sees exactly what I'm saying around the world. See, there's economists all around the world, and they're just sitting there laughing like, dudes, why are you buying treasuries? They're like, oh, because the stock market, it keeps rising. I mean, another 10, 20% this year. They're like, that's why. And we can get 4.2, 4.4% for 2 years or 10-year notes. You know, if we buy their treasuries, and we'll be in the favored nations kind of thing, like we're friends. And, you know, and by the way, we're going to be buying gold and silver. A lot of gold and silver because we know this is all coming down and we're going to take the benefit of the 25% every year or thereabout that goes up from our insider trading. So again, that gives them a huge advantage. So they're rocking until they're not. They're no longer rocking with this anymore. All right. The world is like, hold on, man. We're not rocking with you guys no more. And by the way, when I make a video tomorrow, you guys, you guys are gonna, you guys are gonna lose it because once you understand the cycle's over for the United States. The empire is coming to an end. This is the same cycle when you have world currency because you can print money. The other countries, they print money too, but your money is the world currency. And that transaction allows you to give out loans. It allows you to do all kind of things that if you don't have world currency that you can do. So this is why all the countries that had world currency all had currency issues because they've done the same thing that America has done. And worse is America because our dollar is not backed by anything, not even oil. All right. Here we go. Joe Nay's in the house. Amazon, UPS Airlines, etc. Thousands of jobs lost or layoffs. Dollar is down and continue to go down. Exactly. That's it. Cycle or centuries old business model. You hit it right on the head, Robert Bonnell. Joe Nay, very happy to see you on the SSN Nation Afternoon Lives edition, the FMOC edition. He done effed around and found out that he can only lie for so long because the numbers don't lie. When I show up and go shopping at the grocery store, at any store, you're looking at prices at like, I was just eating in this restaurant like 2 months ago. This thing used to be like $10. Wait, this is $15 now. What's happening? Cycle or centuries old business. You know what? That is very good you've said that because that's what people don't even realize. Well, when you have an administration that says we don't want to do green energy, that is a death knell, ladies and gentlemen, because we're going to be producing, well, I'll put it this way, energy cost is going to increase. And if you're not producing more energy and keeping with demands, that means it's going to cost you a lot more. And eventually there's going to be a stop because you're going to surge. And now if Canada said, you know what, we're going to cut off the energy that we're sending to you or any other country, you're on your own. That will be a problem. And you know what else is the problem? Oil is not the way it used to be. You can't manipulate it anymore. The US and the EU, you can't manipulate it. So now that you can't manipulate oil because other countries were smart, they said, you know what, why are we dealing with this oil stuff? We could just build windmills, solar panels, streets paved with charging. Come on, you know, EV vehicles. And we produce more green energy, which uses some oil, but that doesn't really matter because there's all different types of oil. It uses oil, but not enough that's going to replace automobile usage of oil because that's the big whole boogeyman in the corner. Soon as you start reducing ICE vehicles, now all of a sudden, that's a problem. More jobs lost for the United States. Union jobs, by the way, livable wage jobs with health care. So all this has, and that's an old business model. You need to go to the new century, which means green energies. Well, even if you sit there and say, well, it use oil, so what? Because that's the bane of this whole thing, because now oil is at $60 or less a barrel. Speaking of old system, it was 100-plus-year-old system for oil. It never should have ran this long. The only reason it ran this long is because the United States had world currency and superpower status because of it. And they, regulated the world. Let me go do something else. Um, we're not even improving our energy grid. They're talking about cutting back online nuclear power plants. We know what that's going to be. when you don't have any infrastructure. You're not spending money on infrastructure. So now you got to turn on a nuclear power plant instead of putting in some green energy situations. Now, who's ahead of us? Probably the next world currency, China. And if China gets world currency, it's a wrap. They're going to use economic warfare, and just like the U.S. and they'll be able to come up bigger and badder than they've ever been already. It's the only next reasonable person, and that's going to be the worst case scenario. The United States, they do have the SWIFT system that nobody else can reproduce right now, but guess what's happening? I'll put this in right now. Bancus, 2 p.m. and 8 p.m. every Thursday and Tuesday, they have their Zoom call. And this is a Bancus a Bancus crypto debit card with the MasterCard logo. And this is what's happening around the world. So you don't have to use the SWIFT system to move money around. See, that's the thing. And that's what the rest of the world has been doing, because they're like, we don't need economic sanctions. So when Jerome Powell sits out here and keeps talking this nonsense, what's happening is the rest of the world is moving around us, and we're going to be paying the debt. So download the Bancus app. And the reason why this is significant is because there's a card that you can order, whether it's a plastic one or a metal card, but that's not the thing. It's in Mexico City is where the company is. And you use crypto to download to the card. So it's basically a prepaid card. But it's outside the USA jurisdiction, and it's not involved with the regulated crypto exchange that you would normally send your money back to. So this goes directly to your card. And here's the kicker. Anybody else who has a Bancus card, if I had $5,000 in my Bancus account and somebody called me up and they lived Singapore, and they said, hey, man, I need some money. I'm checking into a hotel. They need like a $500, $1,000 deposit. I don't have any credit cards with that type of range on it. So, okay. You have a Bancus card, right? Okay, I need your email address. I'll send you the 1,000 right now. It'll be on his card. He'll be able to check in within minutes, bypassing the SWIFT banking system. Just so you understand. So just because, and how much did it cost? $0 for me to send him the money. This is why my friends in Mexico and Guatemala and all the Central Americas, they're like, are you kidding me? I said, yeah, but the only problem is it costs 4%. They're like, we don't care because they can have a card. That means they have the money instantly and they can go out shopping. I don't have to wire it to them and then wait on the wire place to open up or be closed or come back the next day or whatever. I said, right, exactly. It's very, very powerful. So that's why I just download the app first, look around, and then listen to what they say on the Zoom call like Tuesdays and Thursdays. And especially if you're into crypto and you want to download crypto somewhere else instead of into a regulated environment, or you want to use it. If you want to put it in your own cold wallet, that's fine, but that would be recommended. Cold wallet or regulated SEC, central exchange. I would not keep money or crypto there. I'm telling you, you're going to be robbed eventually. All right. And don't believe the Clarity Act. All right. Oh, I missed something. Diesel. I'm glad you mentioned this. Diesel runs on anything. That is correct. That is correct. That's why you can do oil, corn oil, vegetable oils. That's correct. Diesel runs on anything, was designed to run on vegetable oil, simple engine, simplicity and decentralization equals freedom. That is why the United States stopped diesel, because they started having people talk just what you're saying. They were like, hey, man, I got a car. It's running on corn oil. They're like, what? Hold on now. We can't have this. It costs a lot less. But back to the oil situation. Our oil is at $60 a barrel or less. Okay, once again, let's do this. We'll Google it. What happens when oil in USA is under 60 a barrel? That's why it looks like right now I'm going to have to do like a two-part series when I do my video because I didn't realize there's all these metrics. Here you go, ladies and gentlemen. Let me pull it up on the screen for you. All right. This is wild. This is some wild stuff. People don't realize what's happening right underneath their feet. The hood's being lifted. Hold on. Let me see. Let's go over here. Share this tab instead. Okay, here you go, ladies and gentlemen. Here you go. Key impacts of sub 60 U.S. oil. Production declines. Many U.S. shale producers go bye-bye. Particularly smaller independent firms struggle to maintain profitability. This often leads to the reduction in active drilling rigs. So they shut down their rigs. Those 200. All right, I'm back. It looks like I got disconnected for a second. Hold on. Okay, there we go. Yeah, see, I got a flicker. I saw a flicker on the screen. So hold on. Yeah, this again, we used to get blocked, ladies and gentlemen. We still get blocked for the information. All right. We get blocked around here, just so you know. All right. This is nothing new. But look at this. You guys can see this right here. See that? Leads to reduction in active drilling rigs. Okay. That's the first thing. So if you have less, those guys are going out of business. All right. Also, the regional guys, they all of a sudden need to get bought up, or they got layoffs, they got everything, right? But they might get bought up by the big boys. But they still turn off the rigs because that's not a profitability number. 60 and under is not profitable. All right. So I'll just start up here at the top so you guys can see it. You can read it yourself. $60 a barrel. Domestic energy sector faces significant pressure, leading to reduced drilling activity, layoffs, and potential bankruptcies among smaller shale producers. That is correct. That's what's happening as we speak. All right. While consumers often benefit from lower gas prices, that's right, the industry sees declined or decreased profitability, causing oil field service companies to slow down operations in key areas like the Permian Basin. Okay, you understand. So when somebody tells you that they're going to go around, do all this crazy stuff like what our administration is doing, and by the feds also reducing rates when they should not be, knowing that this is happening, right? So let's see. WTI crude. By the way, you're going to shut down refineries, which now some more livable wage jobs happen. Okay, here's the crude futures. Let's see. What do we got today? What do we have today? Let's see. So now you guys understand. What's the number? We're up to 60. Oh, the futures are 62. So we're at 62. We're not under 60. Oh, okay. 5 hours ago, oil pricing continues to rise as U.S. crude oil inventories drop. Oh, that's by default. Of course, they're going to drop. That's exactly the point. They have to reduce production. And by default, that cuts off the oil. So now it was under 60 like a week or two back and a month back. So I'm happy it has risen, but this is the return of your investment, ladies and gentlemen. And that also means gas prices have to go up, right? Just saying. All right. So here we are. Just saying. So they reduce, and now all you have to do is have OPEC reduce, which is what's going to happen in order to make it go higher. All right. So therefore, there you go. And that's why diesel ban is almost 30 or 40% of all cars on the road. So that was pretty sweet. Let's see. Okay, I got. Okay. All right, hopefully, you guys. I wasn't going to be on this long, but gotta go. Like, subscribe. Thank you. Thank you so much, man. Thank you for being in the house, giving us your valuable insight. Greatly appreciated. Also, pay attention to gold and silver. It's gone up if you're in the stock market. It's rising. All right. Last night it moved big. Big. It went up to 5,300, over $5,300 per ounce. And it might even rise some more because guess it's a squeeze. It's a short squeeze happening right now. So if you know how to trade, you should probably be in the stock market. Okay. That's what you should do. Or you should be figuring out how you can benefit and ride the coattails of this gold and silver and everything going up. Let's go see right now what CNBC is saying. They're starting to tick me off as well because, you know, see this right here. Trump is not worried by a weak dollar. And then they're going to tell people on TV, they're going to say things like, well, that reduces our deficit. I'm like, what are you talking about? Again, how does it if somebody wants to comment down below, tell me how it reduces the deficit. How much you owe or anything. It doesn't change anything. The percentage is still a percentage. If I owe somebody 4% every year on $1 trillion, well, $40 trillion, what does it matter? If what are we talking about now? If the only thing that normally would happen, the weak dollar used to mean people who ordered from manufacturers inside the USA would now have an advantage, just similar to like when we go to a third world country and they go, oh yeah, it's 5-1, it's 10-1, it's 60-1. So that's what it was. It'd be like the EU could be like, I'll use an outlier, but let's just say it was $1.25 to a dollar, right? So now, when on the translation, it costs less to order the same items based on that if you're in the EU. But remember, Trump says we're going to do a 25% tariff. So that eliminates that. That's why him saying that it's a weak dollar and he doesn't care, he should care if he's doing tariffs because now it's 25%. And now the companies inside the United States have to pay more on arrival. The companies outside are paying more, 25% more, except that 25% more, it costs the United States company. That's how it works. So that's a problem. And there we go. S&P 500 went past 7,000. Told you. That's who they work for by doing what he said today. And let's see what gold and silver's doing. Let's go check this out. Let's go look. It should have had some impact. I guess it's probably just going to keep rising. I don't know how it wouldn't. I mean, somewhat. It's probably going to have a rise and a little fall, a rise, because you have to understand the banks and everybody, they're trying to keep the price down. Just remember that. These guys are out here messing with you guys. And they haven't been able to do it because other countries are buying trillions of dollars, all combined, worth of gold and silver, the physical. And now these guys are going to have to go buy because remember, oh, wait, where's the number? They're going to have to go. They want the physical, not paper. They want physical. What's happening with the markets today? Did I mess something up? I mean, is it 4? No, it's not 5. Okay. Bonds. Yeah, that's not good. Why am I having, this is crazy. This is different. Okay, let's see if I can get these commodities up. I could have just went to the XAU and XAUG, I guess, but sheesh. Metals, gold, oh my, it's going to be 5,400 here shortly. plus 292, ladies and gentlemen. Silver, 116. These are all bullets. They're rising. Palladium, rising. Platinum, rising. Copper, rising. All right. 10% for palladium, 5.7 for gold, 5.93 for platinum, 10.23 for silver, 2 for copper. Wow. It's going to continue. It looks like 53.65. I think it went to 5,400 last night. Just saying. All right. It was a good night. Okay, ladies and gentlemen, thank you so much for being here. I'm going to wrap this up. Just remember, get your assets while you can. Once you understand what they're doing, then you need to ride the coattails. Gold, silver, a little bit of crypto, even though it's down. It's probably going to go down a little bit more, but you should be, if you're new to it, grab some. Just a little bit of all this gold, silver, platinum, palladium, whatever you want to do with metals, a little bit, just a little, because you can buy grams, ounces. All right. So you don't have to get big bars and all that. You can just get a few grams, just a little bit, just because we know it's hard out here. All right. Just remember, smash that like button on the way out. Thank you so much for being here. And let me know what you think on this replay. And with all that said, ladies and gentlemen, make sure you stay safe out here because you never know what's going to happen. You never know. So make sure you keep your head up. Keep moving.